Stocks fell pretty sharply on Wall Street today, with the S&P 500 being down more than 1%. However, this was only the second time in the month of July that we've closed lower by more than 1%, which means that we've been operating within a relatively calm environment compared to the first half of 2022. Stocks fell today largely on the backs of news from Walmart suggesting that their inventory buildup is leading to kind of some sales pressures that they're expecting in their future quarters. But the good news is we're hearing from a lot of stocks after hours here tonight with their own earnings announcements where stocks are popping up. And those are stocks like Microsoft and Alphabet. We'll go through a number of them in tonight's video. So things stand a pretty good chance of starting off on a positive foot first thing tomorrow morning before we hear from Jerome Powell and company regarding the interest rate decision, which of course could cause some volatility at that time. We'll then take a look at a lot of our different postures across the different financial asset classes out there, and then we'll finish tonight's video with a trade application example where I wanted to feature a put selling idea on a dividend stock within the materials sector that appears to be at a pretty attractive point at this moment in time. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's July 26th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below and make sure you're signed up for our email distribution list, which you can find in our description area. So that way you can be notified whenever we post these videos. We'll also let you know which stocks are giving you overbought and oversold cluster signals within the S&P 500 at the bottom of those emails. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. I would encourage you to follow me if you haven't done so already. We really appreciate those of you that click like and retweet to help support these Market Outlook videos on Twitter. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, we've got our S&P 500 heat map pulled up in front of us. And unfortunately, it was a little bit of a Debbie Downer type of a day, as we've got a lot of red squares there that are staring us straight in the face. And unfortunately, it's a lot of the bigger squares and rectangles that end up in that red color. We see Microsoft in the upper left, we see Apple, we see Alphabet, we see Amazon, we see Tesla, Home Depot, Visa, Nvidia, all those biggies in the red. Now, the one that was actually one of the biggest stories of the day was actually Walmart. It was down about 7.5%, 7.6% to be exact. That actually was a bit of a recovery. Before the market opened, it was down even more than that. But Walmart came out with a pre-announcement where they are expecting a disappointment in some of their sales and revenues and earnings and all that good stuff. And so, unfortunately, as I mentioned on Twitter, it kind of felt like deja vu, because many of you will recall that back in May, we had a really terrible week with retailers in the stock market, largely led by Target, but Walmart was down kind of in sympathy. And today we kind of had part two of that story. Unfortunately, they just can't seem to get things together there, as it sounds like many of those retailers here in the United States have ordered a bit too much inventory and are having a hard time selling that. So unfortunately, the stock has taken a hit as a result of that. You'll see that there are a number of green squares out there today, including Coca-Cola, which reported a nice earnings announcement. Of course, one of the dividend kings out there. That helped Pepsi and a few of the other beverage stocks go up nicely here today. We actually had a conversation about 3 beverage companies yesterday in my top-down trend trading class. So you can see in general, the consumer staples held up pretty well today. Now keep in mind, Walmart is considered a consumer staple, as is Costco. Oddly enough, Target is not. Target is housed within the discretionary space. So other than Walmart, Costco, and Cisco, Estee Lauder, and then Clorox was down a little bit. You can see the vast majority of the other consumer staples actually did close in the green here today. You also saw a nice green patch down below within the utilities. You had NextEra Energy, that was kind of the outlier there. That's been known as more of a growth-oriented utility in recent years and probably has a higher valuation than most of these other utilities that haven't really benefited from that alternative energy mindset that has benefited NextEra Energy. And so the traditional utilities largely closed in the green. In fact, I don't see a single utility other than NextEra that closed in the red today. All the rest were in the green, so that was another consistent area to be hanging out in. Another area that seems to have been kind of withstanding the market pressures today was healthcare. Take a look at all those healthcare names in the green. Everything from your big boys out there like Johnson & Johnson, all the way to some of the smaller players like, let's see, a Cardinal Health or a Dentsply. Here's another smaller one, Viatris, that was up nicely. So it looks like healthcare wasn't quite as consistent to the green side as something like the utilities, but nonetheless, overwhelming majority of healthcare companies did close nicely in the green today. Also, a quick shout out for 3M. Many of you that know me know that I'm a dividend growth investor, and 3M, like Coca-Cola, is a dividend king, meaning that it's raised its dividends for over 50 years in a row or more. And 3M, unfortunately, unlike Coca-Cola, has not had a very good track record in terms of its stock price here in the last couple of years, as they've been struggling with a lot of lawsuits and other things that they're dealing with on a unique basis. But today they came out and said they're spinning off their healthcare division, which can kind of push some of those liabilities into a different company, and that might help their overall parent structure there. So it looked like the market was kind of cheerleading that decision here today, as the stock did close higher by about 5% here today. So again, today was a pretty big sell-off day. The market was down over 1%. You can see a big reason behind that is all those mega cap stocks that did close in the red. That's the bad news. Here's the good news. Today was an incredibly important earnings day, and therefore many of these companies, including Microsoft, reported earnings after the bell, as did Alphabet. And largely, the market has been treating them quite well after hours. So maybe we can take a quick moment here, since today is such a big day for earnings announcements, to kind of look at a handful of those individual movers. Remember, this is the big kahuna earnings week, as I referenced it on Twitter here over the weekend. In other words, this is probably the most important earnings week when you take into consideration the total amount of companies reporting earnings and their market caps. So this is a week where you have not only Microsoft and Alphabet reporting, but later this week we're going to hear from Apple and Amazon, and so it's a biggie. So let's go ahead and review some of those, because there is good news on that front. Let me go ahead and pop on over here to the platform briefly. Oh, and by the way, before I transition from this screen, here's what the kind of the breadth measures broke down today within the S&P 500. 181 stocks within the S&P 500 closed in the green, 321 closing in the red. So it was about a 1/3 to 2/3 split here today, with 1/3 closing in the green, 2/3 approximately closing in the red. So it was a pretty broad-based sell-off, all things considered, even though the stocks like Walmart and Apple and Microsoft and Amazon and some of those kind of stole the thunder. It wasn't as though it was only a sell-off in the large cap stocks. We did have plenty of smaller companies selling off today as well. But let's go back to the good news here. It's always more fun to talk about the good news. So let me show you what's going on right now with Microsoft after hours. Microsoft reported their earnings. They closed the normal session at around $252, but you can see after hours the bid and ask here suggests that we are currently trading higher. We're up there at about $263 here as I speak, but it's kind of been all over the board, quite frankly. The initial reaction to earnings from Microsoft actually sent the stock lower. You can see in the after hours session, Microsoft touched as low as $243 per share, but now that the conference call is in full swing and they're issuing future guidance and all that good stuff, sometimes some more positive news can be unveiled as the after hours session moves along, and we have advanced all the way from a low of $243, now $20 higher, to $263, which would effectively eliminate the entire loss that Microsoft suffered in the normal session today, and then some, and tacking on a couple of extra bucks for good measure. So hopefully that's a promising sign. As Microsoft is one of the two largest publicly traded companies here in the United States, it still holds a lot of sway over our indices here. So hopefully some good vibrations going into tomorrow morning as a result of Microsoft. Let's talk about Google now, or what they refer to as Alphabet these days. Google ended today's session at 105. They were awfully close to their 52-week low. Remember, the month of July has been a pretty strong month for stocks, yet Google really did not separate itself from its 52-week lows all that much in this month. So we closed today at 105. The 52-week low was just under 102. So we were in jeopardy of breaching that 52-week low if earnings would have come out and would have been disappointing. The good news is, looks like investors are somewhat cheering the number, as that stock is trading up after hours by about $5 per share. So it looks like at this moment we're trading at about 110 in the after hours session, even though it closed at 105 today. So, that's another good sign there. While Alphabet's market cap isn't quite as large as Microsoft, it's not far behind. And so we've got two of our biggest companies here in the United States trading up nicely after hours. That bodes well for tomorrow morning's open, all else being equal in the stock market. So that's a good response after what felt like a little bit more of a hairy session here today, with the markets down over 1%. In fact, I was looking at this other chart. Let me go over to this for a second. And I just wanted to point out, since today was a day when the market was down more than 1%, I like to show you guys this particular chart whenever we have a 1% move up or down. And as you can see, this red line here in the middle stretches down below this blue horizontal line, which is the 1% price move to the downside. So we were down more than 1%. But as I was looking at this, I was thinking to myself, boy, it's been a pretty calm July. It's been nice for once, because it felt like the first half of this year was just a little too chaotic for my liking. Now, naturally, I'm, as a long-term investor, more focused on stocks to the long side. So for those of you that have been shorting this market heavily, you've probably enjoyed the first half of the year. But for the rest of us mere mortals, it was a tough one. But the month of July actually has been reasonably calm. And believe it or not, this is only the second day this month. And remember, we're almost at the end of the month of July already. But this is only the second day this month where we've closed down more than 1% on the S&P 500. The only other day was right here, July 11th. This day back here happened to be the last couple of days of June, so that wouldn't count for this month. So today was only the second day in the month of July for the S&P 500 to close down more than 1%. And you can see that we've actually had 3 days where the market was up more than 1%. So this has been a month where the bulls have seemingly bested the bears, which we have not been able to say very often here in 2022. But anyway, going back here now to some of those companies that are reporting after hours, hopefully with today being just the second day in the month of July with more than a 1% down day, there could have been that feeling of, this rolling over and this idea that, it was just a matter of time before the bears take over again. So we were kind of on a slippery slope as we went into the closing bell today. So I think it is a very good sign that Google and Microsoft are both going to do their best to support the market open first thing tomorrow morning. Now keep in mind, things can change in the overnight session with the futures market, so we have to account for that as well. The other big news, of course, is tomorrow we're going to hear from the Fed and what they are going to determine about interest rates. And a lot of folks are expecting at this moment in time 75 basis points. There's a handful of people that are thinking maybe they'll go big and do 100 basis points. But the point is, the Fed is still in inflation fighting mode right now and is highly expected to raise interest rates tomorrow. So even if the market does open up nicely tomorrow morning on the backs of what we're seeing here after hours with Microsoft and Alphabet, it doesn't guarantee that tomorrow is going to be an excellent day, because about midday, if we hear the wrong information coming out of Jerome Powell's mouth, it's entirely possible that those gains could be evaporated. Then again, maybe it's just fuel for the fire, and maybe we continue to push higher here in the month of July. But the point is, probably going to be some more volatility tomorrow as a result of the Federal Reserve. Let's take a look at a couple of other after-hours movers here tonight. Texas Instruments is also moving to the upside here this evening. Now, this was a stock that we actually just sold a put on in my class on Monday afternoon, my Options for Long-Term Investors class. In that class, we focus purely on dividend growth investing companies, but rather than just buying them outright in the stock market like we do in my Tuesday morning dividend growth investing class, instead we choose to sell put options on them in order to establish our position. So slightly different way of approaching long-term investing, but nonetheless, I'm happy at this point that we made that decision on Monday afternoon, because it looks like Texas Instruments is trading up after hours by about $5 per share. It closed under 161 here today, and it's trading above 165 in the after hours there as a key semiconductor company here in the United States. Let's take a look at another one. Let's take a look at Chipotle, one of my favorite fast food restaurants out there. And Chipotle is also showering investors with cash after hours. You can see that it closed tonight at $13.16, so this is a higher price stock, so $1,316 per share for Chipotle is where it went out in the regular session. But after hours, after accounting for their earnings announcement, you can see the shares are now trading up by more than $100 per share. So they're trading at around $1,430 right now. So that's another big market mover to the upside. Let's take a look at another one, ENPH. This is Enphase Energy. This is another semiconductor company, one that is focused more purely on solar energy. And this is another one that is trading up nicely after hours. It ended the session at 216, and it is currently trading in the after hours session up here at a close to about $234. So it's up almost $20 per share there. So good round of earnings per share responses thus far, and the only other one I had on my list that was big enough to talk about at this moment is Visa. And unfortunately, this one was one that was just a little bit of an outlier where it's not really going up after hours. It closed today's normal session at 212, and it's currently trading just a hair below 212 right now. You might be able to find this one at break even as we come into tomorrow morning. So I would say that, judging by what we just witnessed, that was probably an A- on the report card right there. The other thing that I thought was helpful about a lot of these earnings reports after hours tonight is that many of them actually missed their numbers. Many of them missed their revenue and earnings estimates, or missed one of those two, and the market didn't punish them. And it gave you the impression that a lot of the damage might have already been baked into the cake on those specific companies. Whether that's true across the rest of the market is anybody's guess. But it did feel a little different than the way that the market was handling companies on last quarter's earnings season, when just the slightest miss would just absolutely hammer those companies, sometimes down 20-30% types of movements. Now we're seeing the companies actually reporting some bad news, but the markets are responding positively to them, and I hope that's a bullish sign for the markets in general. So anyway, that's your earnings rundown for the night. I don't always do that because it does soak up quite a bit of our time, but because tonight was such an important night when it came to the companies that were reporting, I felt like it was useful information for you guys to be aware of as you head into tomorrow morning's trading. Let's go ahead and now get kind of back on track with our typical routine and do some analysis here on the charts. And let's pull up our 12 grid here. I'm sorry, our 4 grid. This is chart 4B, looking at the 4 major U.S. equity indices. And as mentioned before, the S&P 500 was down more than 1% today. It was 1.15% today, to be exact. The Dow Jones fared a little bit better. It didn't close down quite 1%. It was only down 0.71%. Believe it or not, the Russell 2000 actually did slightly better than that. So the Russell 2000 small cap universe was down just 0.69%. So that was the best performer today on a relative basis. So still down, but sold off the least amount. And then the one that sold off the most was the NASDAQ Composite. It was down 1.87% today. And again, looking at that, that heat map that we were looking at before, it should make sense, right? You see Tesla and Amazon and Alphabet and Microsoft and Apple all down pretty significantly. Those are all big NASDAQ related names there. So hopefully with what we know with the after hours session here tonight, maybe there's a decent chance that the NASDAQ can actually lead us tomorrow if the markets are up, because again, with stocks like Alphabet and Microsoft up after hours, it's going to have more of an impact on the NASDAQ than it's going to have on something like the Russell 2000 in all likelihood. So keep your eye on that possibility tomorrow. So after the damage was done here today, you can see how things have shaken out from a posture perspective. We remain with a strongly bullish posture on the S&P 500, the Dow Jones Industrial Average, and the Russell 2000. We see that dark green background color suggesting that that intermediate line, that green line down below, is trending in the right direction despite today's sell-off. So there was enough positive momentum prior to today that we can withstand a day or two of selling off and still retain the posture. The NASDAQ is the only one that lost its posture here today. Now keep in mind that the NASDAQ has actually been down 3 days in a row. You can't make that claim with any of the other indices because all of the other indices were actually up yesterday. The NASDAQ was actually down yesterday. So this is the third straight down day for the NASDAQ. So there's been a little bit more near-term pressure on it. However, in this particular instance, I'm not sure I would read too much into that posture change. Now, of course, I can be wrong. I've been wrong plenty in the past, and I'm positive I'll be wrong plenty in the future. That's the nature of this business. But the reason I say that or make that comment is because if you look at the intermediate reading of the NASDAQ, it's at 77 right now. It's actually higher than all these other three. It's just that the other three are rising with their line, so they get the benefit of still being able to be called a bullish posture. The NASDAQ has its line falling, but it has the highest reading of its line. So you can see how closely the NASDAQ is flirting with the upper reversal zone there. Remember, if you're one of our premium members, you can right-click on the chart in question and go to Maximize Sell. So in this case, I'll just show you the NASDAQ Composite so we can see this information a little bit easier. And notice that that green line appears to be just drifting sideways. Technically, it's going down just a touch, which is why that background color changed to light pink, which suggests it's weakly bearish. Not strongly bearish, but weakly bearish. But because this is so close to the upper reversal zone, remember, all this green line needs to do is get above 80, and we'd be right back to a strongly bullish posture. There's a decent chance that happens tomorrow as long as Jerome Powell doesn't squash the morning rally attempt off the back of these tech stocks that are reporting earnings after hours here tonight. So anyway, yes, it's true technically that we went to a weekly bearish posture as of this moment in time on the NASDAQ, but we are in a situation right now where that could be very quickly erased under the right types of circumstances. And remember, the NASDAQ, despite selling off 3 days in a row, is still easily above its rising 30-day moving average. Notice that there is still an air pocket between where it's trading right now and where the moving average is. And remember, that was one of the things that we kind of discussed in the video on Thursday when I was last with you, is this idea that this current attempt that the market is making here in the month of July is more substantial than what we've witnessed in prior months earlier this year. And my reasoning behind that is because of the air pockets between where the indices are trading and their 30-day moving averages. We continue to have that feature. Now, it doesn't guarantee that this is going to work, right? But it's just merely recognizing that the attempt is stronger right now. And therefore, if there's a chance for the bulls to kind of pull a rabbit out of their hat, they still have that opportunity. We're not in a situation where all hope is lost here all of a sudden or anything along those lines. So let's keep our eyes on that. It's natural for markets to back and fill. And with the NASDAQ pulling back 3 days in a row, all it's really done is given back some of those gains that it had in the week before, but we remain above the average price over the last 30 days, and that's an important, bullish sign for the markets, all else being equal. So these charts, as you can see, all have green 30-day moving averages at their tips here currently, meaning that price is above rising moving averages in all 4 of these cases. And in 3 out of these 4 charts, we still have strongly bullish postures. The NASDAQ is the only exception to that, but that could be very short-lived. It's entirely possible that as soon as tomorrow or the next day, the NASDAQ could be right back to a strongly bullish posture. But we've got the Federal Reserve that we need to keep our eyes on, as that has a huge impact on markets these days. All right, let's go ahead and step away to the internet here briefly. I always like to get a chance to say thank you to those of you that help support these free videos. Remember, they take at least 3 hours out of David and I's days, and so we really have to question whether they're worthwhile doing or not. I know many of you enjoy them, and so we don't take that lightly. We want to make sure that we're doing them if they are being, supported. And one way to support the videos is just by merely clicking like there for us on Twitter. You don't have to pay us a cent. These are completely free videos that you can find on YouTube, whether you're one of our clients or not. Our hope is that we give you a little bit of basic education here during these free videos, and that way you guys get a benefit for watching the videos, and then hopefully David and I get a benefit as well by getting the word out about our organization here at Market Scholars. And the hope is that eventually a handful of you will become premium members of our organization down the road when you want to take your investing education to the next level. So it's kind of a symbiotic relationship there, but it is true that we need to make sure that you guys are getting value out of these videos and that you're motivated enough to help support us. Otherwise, the word doesn't get out about our organization, and it kind of defeats the point of us doing it for that portion of our motivation. So thank you for helping us along with that. I thank all 106 of you that clicked like for me the last time I did the video on Thursday. As I always say, as long as we're up and over 100 likes, I'm happy to do a full-length version of the video, including a trade application example, the next time I'm scheduled to do the video. And remember, I tend to do the videos on Tuesdays and Thursdays. David does the other days. And so I will be keeping my eye on the likes on Twitter between now and Thursday, and if we're up and over 100, I'll plan on doing another full-length video at that day. On the other hand, some of you might be getting sicker of these longer form videos. You might think, boy, there's a lot of content out there, and it's hard for me to digest as much of it as I want, so it's kind of harder to listen to these 45 minutes to an hour long types of videos. We understand that as well, and we certainly respect the fact that you've got a lot on your plate, just like we've got a lot on ours. And so for those of you that prefer the shorter form videos, then just don't click like, because if we're under 100 likes, then I will just plan on doing a 15-minute video where there will not be a trade application example, and we only focus on the indices. So I'll let you guys collectively decide, do you like the longer form video, or would you just prefer a very short, quick hitter, kind of quick little recap of the indices themselves? So if you want to support the longer form video, just do one favor for me and click like on Twitter. Also, earlier today, as I mentioned a moment ago, I taught my dividend growth investing class, where we focus on the information technology sector. So we had another excellent head-to-head matchup in that class between a 4-star selection and a 5-star selection, according to Morningstar's analysis at least. So if you're interested in that conversation and you're a premium member of Market Scholars, that has now been posted to the Trading Rooms tab up above. Tomorrow morning we have a slight schedule change. David's got some personal things going on later on in the day, so he typically teaches his options inventory class in the afternoon, but tomorrow he's going to get started first thing in the morning, 9:30 a.m. Eastern Time. So make sure you're aware of that if you were planning on attending that class. And then I'll be teaching my factor-based swing trading class at 11 a.m. Eastern Time, just like I typically do on Wednesdays. Also, while we're here on the internet, let's take a brief look here at the Sector Selector tool. Remember, I update this on Friday nights, so it's a couple days stale right now, but it does give us a general sense as to movements we are seeing within the various sectors out there. And as I alluded to on Thursday when I said I have a sneaky suspicion that consumer staples will no longer be number one, you can see it is now official. Consumer staples has slipped to the number 2 position. Consumer staples was number 1 for 4 weeks in a row. Remember, they were the ones that eventually supplanted energy up there at the top, where energy had been number 1 for the entire year up until the end of June, and then consumer staples overtook them for a full month. And now we have a brand new king, and that is information technology. Now, one word of caution around this. This ranking system that I use, first of all, it is based upon an equal weighted ranking system, not a market cap weighted ranking system. And the ranking system uses inputs from a variety of time frames to determine which sectors are stronger versus which ones are weaker. There's a number of inputs that go into it, but the biggest input that goes into it is what is the performance of the sector over the last month. And so we are seeing a lot more aggressive movements here in the rankings than we typically have in the past. And the reason for that is it was just about a month ago, remember, at the end of June, when the markets were completely collapsing upon themselves. Remember how we were talking about how the first 6 months of the year was basically the worst in my lifetime. And then right after the end of June is when we finally started to get this rally. So that was about 1 month ago. And so we're seeing an impact on these sectors here, somewhat based upon which ones have snapped back the most aggressively during the last month. Now, there's still other inputs like 6 month and 3 months and other things that are going into it, but it is that 1 month that is the most influential. So that's why we're seeing a little bit more extreme movements right now because of what the last month has represented. Remember, most months do not look like what we just experienced in the last month, where we went from an extreme low to a pretty aggressive bounce in just kind of a 4-week time period. So be careful with that. It's interesting to note, but you never want to bet the farm or anything along those lines on just one piece of information. You want to use it in conjunction with other sources and other information and research that you're doing there. But it is interesting to see that one of the more compounding growth oriented areas of the market, information technology, has been kind of starting to get some nice strength behind it once again. On the downside, we do see that materials is back in the bottom position there, as a lot of those commodities like iron ore and copper and gold mining especially. I saw Newmont and Barrick and some of those gold stocks are really struggling right now. So that is adding to the weakness there within the materials sector itself. All right, let's go ahead and pop back on over here to the main part of the platform, and let's do some 12 grid analysis now. And we'll get started here with chart 5A, which is the asset class 12 grid. And a reminder that the background colors of these charts will show us whether we have a bullish posture or a bearish posture using the market forecast intermediate line. And remember, on this first 12 grid, it's natural for us to have a mix of green and red charts because we're talking about all different types of asset classes here. We're not just talking about stocks that oftentimes are highly correlated to one another. So let's go through and see what we can learn from these different asset classes here. So first of all, let's go ahead and talk about the US dollar, which we'll find in the lower left-hand corner. A reminder that the US dollar has been one of the strongest asset classes in the market in 2022. I know that probably sounds a bit peculiar because you usually don't think that the value of that dollar bill you have in your wallet is improving or detracting at a great rate, at least compared to a volatile stock. But At any rate, because of the way that things have shaken out this year, where both the bond market and the stock market have gotten clobbered, believe it or not, it's the value of your currency that's actually held up the best. The US dollar, at least according to UUP, which is basing the US dollar versus a basket of other securities of most importance, the euro, is up about 5% over the last 3 months. And you can see this is a pretty nice looking trend here for UUP. Remember when I was with you on Thursday, we were talking about how UUP had, I believe it was a weekly bearish posture at that time, but I said I wouldn't read too much into that because we were still above that rising moving average. And yes, it was true. We had a fairly sharp pullback there from its highs on July 14th. I felt like the trend was still safe. And as you can see today, with a pretty nice bounce back of 0.77%, we are now bouncing up and off of that rising 30-day moving average, and we are back to a strongly bullish posture there. So that still is one of the better looking charts on the board. You can see that when the dollar is strong, you are going to have a greater capacity for commodities to be weak, and we did experience that here today with both gold and oil closing lower here, and both of them having strongly bearish postures, right? So strongly bullish posture for the dollar. So the dollar is very strong, which in turn oftentimes means that commodities are very weak. And that is exactly what we are seeing right now. Gold is in the house of pain. It is truly peculiar and a little bit bizarre to see gold doing so poorly in such a high inflationary environment, but that's why they play the game, as the saying goes, right? It's never a layup, it's never a slam dunk, however you want to say that. They've actually got to go out there and play all parts of the game, and right now we're just seeing that gold cannot get it together, and we are in a sharp decline there, and that's carrying over to those gold mining companies that I mentioned previously, like Newmont and Barrick and some of those bigger players. Oil had been doing quite well earlier this year, as most of you are aware, but even that has had a very sharp negative reaction here over just the last month or so. We topped out in oil back here on basically June 8th, and you can see that we are now down pretty significantly, not only from that level, but we're actually down on a 3-month rolling basis right now. We're down 1.7% over the last 3 months, despite going to multi-year highs along the way. So easy come, easy go is the story there when it comes to oil. But as you can see, with both gold and oil, we have red moving averages suggesting that price is below a falling moving average right now. Take a look at what's going on with treasury yields now in our lower right-hand corner here. This is ticker symbol TNX on the Thinkorswim platform if you need to look at it. And remember, you'd move that decimal point over to the left one to see what the 10-year treasury yield is at this moment in time. So we actually closed below 2.8% on the 10-year treasury yield. Remember those weeks where we would come into these videos and talk about how the 10-year treasury yield was above 3% somewhat regularly? Well, that's kind of in the rearview mirror at this moment. It's not to say that we can't get back there, but it is interesting to see that we've actually seen a sell-off in yields for 3 out of the last 4 days, and they've been pretty aggressive movements lower. As you can see, we are far removed from that 30-day moving average itself on that 10-year U.S. Treasury yield. And so it'll be interesting to see how or if that gets impacted tomorrow with Jerome Powell's comments and interest rate decision. But right now, there's been a little bit of a relief there. And remember, that's part of the reason of what we see over here. You know, I brought this up last Thursday to you guys as well, but in case you didn't listen to that video, I'll reiterate it once again. Many of the information technology stocks and growth stocks in general are what would be referred to as long duration assets. And they prefer to see interest rates low, not high, because of the discounting rate when you're looking at earnings that are far off into the future as opposed to earnings that are right here in front of us right now, you want to see that that discount rate is going to be as low as possible. So when interest rates go up, that discount rate gets high, and it makes that hurdle rate harder to step over in the near term. So what we saw earlier this year, when interest rates were going up what felt like nearly every day, we found that a lot of the growth-oriented areas of the market suffered the most. Remember when we were talking about the NASDAQ composite being down 30% from its highs, the S&P 500 was only down 20% from its highs. So just judging that, you can see that the growth-oriented areas really struggled earlier this year, and part of that was probably because of what was happening with interest rates going up, 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 and away. Well, now we're starting to see a little bit of an unwind there, and that's part of the reason why we're probably seeing technology catching a bid here all of a sudden. So that's been very interesting to recognize here as well. Despite what has felt like a lot of volatility with interest rates in the last 3 months, you can see interest rates are effectively flat over that time period. They're up less than 100 basis points, I guess you would say, on an interest rate like this. So, you're basically trading exactly where you were 3 months ago, and you're well below that falling 30-day moving average. Now remember, when interest rates are faltering, the opposite is true for bond prices themselves. Bonds continue to catch a bid. Notice that TLT, BNDX, which represents foreign bonds, and then HYG, which represents high yield bonds, all have green background charts, meaning that we have strongly bullish postures across all three of those important bond categories right now. And you'll notice that not only do they have strongly bullish postures, but all three of their moving averages are now green. So prices above rising moving averages in all of those cases as well. So, finally that has kind of taken a little bit of a turn. Remember, we were in kind of the house of the pain there for a while. I did a few different trades on TLT earlier this year. Some of them worked, some of them did not, because the market just kept on pushing lower. But I figured we must be getting closer to some sort of at least a near-term bottom, and we finally found that there in the middle of June, and we are now well above those lows in the bond market in just basically a month or a month and a half's worth of time. So things are feeling a little bit more calm here all of a sudden with TLT, and actually have stabilized quite nicely there with the long-term treasury market. In terms of our foreign stock markets up above, EFA and EEM both have weekly bullish postures at this moment in time. Of the two, I would say that EFA looks slightly better because you can see it is positioned above its falling 30-day moving average, whereas EEM is positioned slightly below its falling 30-day moving average. So of the two, if I were trying to force a bearish trade, I'd probably be looking at EEM personally, just because of the way that the chart looks. And that is a little bit counterintuitive to my own mind, because I'm thinking right now that markets have been willing to take on a little bit more risk here recently, and typically when markets have been in a little bit more of a risk-on mindset, they prefer the emerging markets more than the developed markets because they're more speculative. But right now we're just not seeing that. So I'm not sure if that's because there are heavy amounts of banks and materials companies and energy companies within the emerging area, or if there's something else going on there. But just be aware of it. Right now, both of them have the weekly bullish postures, but their charts do not look quite as strong as what we see here in the equity markets in the United States. Speaking of which, let's take a look at the sectors in the United States right now. Looking at chart 5C, the U.S. sectors 12 grid. And as you can see, we only have one pink chart on the board, which means that stock market here in the U.S. has been pretty strong here recently, and confirms what we were talking about earlier in the presentation by stating that today was only the second 1% down day for the U.S. stock market in the month of July. You can see that the only chart that is pink at this moment is communications. And that might very well get a chance to rebound a bit tomorrow if we do find that Alphabet has its way. Now keep in mind that Meta or Facebook is going to be reporting their earnings. It might even be tomorrow. And so that can have some influence there, as well as Meta and Alphabet are the two biggest movers within communications because they have the biggest market caps there. But remember, communications really got hit last week as a result of what we heard out of Snapchat. That stock was down like, I don't know, 25 or 30% or something like that in a single day, and it basically forced a lot of those other social media players down right alongside of it. So that's the area that seems to be struggling right now. Other than that, you can see that things have stabilized pretty nicely across the rest of the markets. It's not that the charts look great, so that's not the takeaway here. It's just that the charts do look better, and we'll take what we can get in a year like 2022, right? Some years we can be a little bit choosier. This year has been a difficult year, to say the least, and so even when markets are just starting to go sideways or just gradually going higher, it feels a little bit more comfortable than the very sharp declines that we experienced earlier in the year. So right now, the big concern is communications, but a lot of these other sectors are now trading above their 30-day moving averages and have bullish intermediate postures. Of all the charts that have the 30-day moving average with a green tip currently, we see that, first of all, the S&P 500 does if you're looking at SPY as the proxy, right, the ETF form of it. And then you can see that technology has a green tip. We've got discretionary with the green tip. We've got healthcare with a green tip. We've got consumer staples with a green tip, and then even real estate managed to get a green tip there. So all of a sudden, we're starting to see a lot of those green tips emerge. And remember, that's a building process there. It basically means that the moving average, which calculates the last 30 days worth of prices, will either tilt in one direction or another if it's bullish or bearish. And if prices are more resilient, it's going to start tilting higher and suggest a little bit more bullishness. And if prices are above that rising 30-day moving average, it suggests that the charts are getting more constructive. So again, I'm not a raging bull in this market right now. I still have concerns about the future, like many of you do. But I will say that things do look more stable now than they did for much of the first half of this year. And so maybe, just maybe, we can try to find a rally here or there into the year end. Remember, that was one of the statistics that I was sharing with you at the end of June, which was, hey, here's the bad news. We just experienced the worst first 6 months of a year in my lifetime. That's the bad news. The good news is that if you look back at the prior instances where you had close to those types of negative first half returns, in almost all of them, I think there was only one exception to it, the second half of the year was actually positive. So from July 1st until December 31st of those years, you had positive gains. Many of them did not offset the losses of the first half of the year, so we don't want to take that concept overboard, but it does mean that there is that possibility of stabilization here in the second half of the year, or at least a lot of us hope so. And so let's go ahead and now talk about our trade application example for the day. And I'm going to bring up chart 2A for this conversation, my dividend stair-step chart. And we're going to have a little bit of a repeat trade here of one that I did similar to it earlier in the year. And this is going to be Scott's Miracle Grow. Many of you know that when the market is down 1% or more, my go-to strategy is selling cash-secured puts on stocks that you wouldn't mind owning at lower prices. I really enjoy doing that, which means I've been very busy. We talked about that this year, that for those of you that have been watching me in these videos, both here and at the predecessor company when we were with TD Ameritrade for the years before that, you'll know that I have not sold as many puts as I have in the year 2022 in this video. So it has been actually a little bit quiet on that front recently because, as I mentioned a moment ago, I tend to like to sell puts when the stock market is getting clobbered. I get a benefit when I'm willing to do that because other people are oftentimes buying puts on days when the stock market is getting clobbered. I want to be the one selling those puts to them. And if there's a lot more buyers of puts because everybody is pulling their hair out and concerned and worried, that means I am better off as the person who is one of the few people willing to sell those puts to them. And when volatility is high, I get juiced up premiums when I'm willing to do that. It's not a perfect approach, and there's plenty of times where it stings you, but in general, I found that to be the preferable route to put selling, which is why we've done so many of them in calendar year 2022. However, the month of July has been different. I'm pretty sure we've only done one new put selling idea in my trade applications here in this video for the month of July, and I think that was Union Pacific, if my memory serves me correctly. So we've been kind of on a little bit of a dry spell from that specific strategy's perspective. We've had other things to keep our attention. And by the way, selling the bear call spread on JP Morgan the last time around worked out nicely on a day like today when the markets were bearish. So sometimes people question you, why are you doing a bearish trade when the markets were up? And I say, well, I want to have something working for the days when the market's not up, which happens quite regularly. And so today is a reminder of why having a little bit of balance in your portfolio can be useful. But anyway, just like I was willing to sell a bear call spread on JP Morgan on Thursday when the market was up, I'm willing to sell a bullish put on SMG today when the market is down, and kind of fade what the general sentiment of Wall Street is on those days. Now, Scott's Miracle-Gro is a company that we sold puts on in this presentation earlier this year as well. So if it sounds familiar, that's probably the reason behind it. I believe at that time we were selling the 75 puts, and that one did test our patience, but it did close at max gain for us just in the nick of time. So it came down there and actually traded a little bit below 75, but on expiration day, it did trade above 75. So we did make 100% max gain on that trade. So let's hope that the good luck streak will continue with this one here once again. And what I did today was I sold the $60 September put. That is way down here, as you can see, within this blue zone of this dividend stair-step chart. For those of you that are newer to looking at this dividend stair-step chart, it's effectively a way for you to determine whether a stock's dividend yield is currently perceived as attractive versus its historical standards. This is the chart that I use in my dividend growth investing class on Tuesday mornings, and also my options for long-term investors class on Monday afternoon. And I have these dividend stair steps set up for about 700 different stocks out there, and it is part of one of the key perks that you guys receive when you become a premium market scholar, for those of you that are curious about that. But anyway, it's done a reasonably good job of helping us find value opportunities within a market like we're in right now. And as you can see, we're actually trading in the blue zone already. So some of you might be wondering, well, why don't you just buy the stock outright? And I don't think that's necessarily a bad idea. Keep in mind that with this particular account, it's not really established for long-term purposes because we have to do so many trade examples during these videos. I need to make sure that my buying power is always open. So we have to kind of handle the trades a little bit differently in this YouTube video account compared to, let's say, my Tuesday morning dividend growth investing account. So anyway, that's part of the reason behind it. The other thing that I would say about it is be aware that this company has earnings coming up. And their earnings are going to be coming up on August 3rd. And some of you might feel a little uncomfortable with that, buying the stock right before their earnings announcement. So by selling the put and putting myself on the hook for buying it at $60, I could give myself a $22 coupon is a way that you might want to think about that. So you can see that the stock is trading at $82 right now. I have now put us on the hook for buying it at $60 per share. So the stock would have to fall $22 from where it's at right now before we'd be obligated to purchase it. And the reason I was able to do that at an acceptable return on risk, I typically do a 1% return on risk. So we were able to get filled at 60 cents or more on selling the $60 put. And the reason that that was available to me was because it does have an earnings announcement associated with it. So when you are trading through an earnings announcement and you're selling puts, you get a built-in advantage if you're willing to take ownership of the underlying security, because a lot of other people are going to be speculating on earnings. And there might be a lot of people trying to buy puts thinking that Scott's Miracle-Gro is going to collapse, and gap lower on their earnings announcement, which very well may happen, which is why why I always stress that when you're selling puts, only sell puts on companies that you are comfortable actually owning at the strike price that you select. And in this particular case, I think that this $22 head start that we have here is an ample amount, even though and despite the fact that we have an earnings announcement coming up. I could be wrong about that. You know, who knows? Maybe the stock gaps lower by 30 bucks on earnings. But it's the gamble I'm willing to take in this particular instance with this particular stock. So that's what I did here today. You can see the stock is already trading at quite a low PE ratio of only 11 times earnings, which, as you can see down below here, is basically at its lowest level of the last 10 years, with the only exception being where it was trading a little bit lower here a month or so ago. And so it's cheap on an earnings basis right now, and it's got a very high dividend yield on a historical basis right now. Obviously a little bit more of a speculative security. This is not a dividend aristocrat, and so this is a company that is a little bit kind of, you can think of it like maybe a second or third tier type of a dividend growth stock. It's not a true blue chip type of a company, but because of that, we're getting more premium when we're selling it as well. So there's always that kind of give and take that you have to think about with these types of setups here. So I think it's a reasonable option here for folks to sell the $60 put. And even though we're going through earnings, I don't anticipate that the stock is going to collapse by more than $22 here in the next month and a half. And so we'll all find out if that will be the case. Of course, only take these trades if you yourself are comfortable with the ideas, because there will be plenty of times where we're just flat out wrong with the way that we establish things. But in this case, I think it's a pretty reasonable setup for this type of a stock and this type of a situation with a company that has a long history of raising the dividend, has a current yield well over 3%, and is giving us a 22%, or I'm sorry, a $22 per share head start. So that's what I had for you here tonight. I hope you got value out of tonight's video. I hope you enjoyed the analysis, taking a look at some of the after hours movers here tonight, because this is such a big day with an earnings perspective. We also have, of course, Jerome Powell scheduled to speak tomorrow, so stay tuned for that. And I hope you got value out of my thoughts here regarding Scott's Miracle-Gro, as we're going to try to roll the dice on it for the second time this year with a sold put opportunity. If you did get value, please click like for me there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do the video on Thursday, I'll plan on taking some time out of my day to look for another trade setup on Thursday. Otherwise, if you prefer the shorter videos, don't click like, and then I can save myself the time. I don't have to look for a trade example on that day. So I'll let you guys decide collectively. But at any rate, I appreciate each and every one of you for checking out the video here tonight, and I'll look forward to seeing you all down the road. Take care, everyone. Bye-bye.